Welcome to the deep dive. Today, we're jumping straight into some sources about, well, a pretty sharp downturn in London's prime property market.
That's right. And specifically, how government policy seems to be a major driver behind it.
Exactly. Our mission here is to quickly connect those dots between policy decisions and, actual investment behavior. We've got Knight Frank research showing activity in prime central London PCL, that sort of top-tier luxury end, has really hit a new low.
It's quite striking. And this isn't just seen as a standard market dip. Analysts are framing it as a potential wealth exodus.
A wealth exodus. Okay. So what are the key findings suggesting is pushing these high net worth investors away?
Well, the analysis points pretty squarely at two things: the end of the non-dom tax status and increases in stamp duty rates.
Right. The non-dom status change comes up a lot. Maybe just a quick reminder for listeners, what did that actually mean in practice for, say, a wealthy international buyer?
Sure. So essentially, that long-standing system allowed some wealthy foreign residents to avoid paying UK tax on their worldwide income. That shield is now gone.
Ah, okay.
And when you add higher stamp duty, the tax you pay when buying property on top of that, well, the whole financial picture for owning super prime London property just got a lot less attractive for international money.
And the numbers seem to back that up, don't they? I mean, sales in prime London down 7% in the 6 months to May compared to last year.
Yes, and maybe more concerning for the future pipeline, new buyer registrations fell quite sharply by 13%.
Wow, 13%. That's a big drop in potential demand, so you'd expect prices to feel that, especially at the very top end.
Absolutely, and they have. In PCL, average prices dropped 2.2% year-on-year to May.
Yeah.
That's actually the steepest annual fall since last August.
And quarterly.
The quarterly fall was 1.4%. Now, that might not sound huge in isolation, but it's the biggest quarterly drop in almost 5 years. It shows a real acceleration downwards.
Okay, but here's where it gets really interesting, based on the sources. This isn't a London-wide collapse, is it?
Not at all. And this is, I think, the crucial piece of evidence for you, the listener. If you look at prime outer London POL, it's a different story.
Right. POL tends to have more domestic buyers, people buying out of necessity, perhaps? Families needing space?
Exactly. More needs-based, less purely investment-driven. There. Average prices actually rose by 1.1% over the same 12 months to May.
Rose. Okay, so PCL down 2.2%, POL up 1.1%.
Precisely. That contrast is, well, it's stark. It strongly suggests these policy changes specifically hit that very mobile international wealth segment that dominates PCL.
It really isolates the impact, doesn't it? Confirms that link between the fiscal decisions and what's happening in that specific part of the market.
The government aimed at a certain group, and, well, the data shows they hit it. But now there are economic consequences.
Which brings us to the wider implications. I mean, a sharp drop in multi-million-pound property deals must mean less stamp duty revenue, fewer related taxes.
A shrinking tax base, yes. And that's a big problem, especially with the government heading towards a pretty critical spending review. The timing is difficult.
Yeah, you can see the pressure building. Knight Frank's research head mentioned the government's tricky position.
It's fascinating politically, too, isn't it? You have the Prime Minister, Keir Starmer, saying publicly the UK can't just tax its way to growth.
Which this PCL situation seems to underline, really. Tax changes appear to be actively shrinking activity, at least in this sector.
Right, but then, almost right after that, you get this leaked memo reportedly from the Deputy PM, Angela Rayner, exploring ways to potentially raise taxes.
So conflicting signals within the government itself.
It seems so. And it puts the Chancellor, Rachel Reeves, in a real bind trying to meet her own fiscal rules.
What are the options then? It feels like a classic catch-22.
Well, the commentary suggests 3 main paths, none very appealing. 1, cut spending further, which is always unpopular. 2, raise other taxes, but that risks worsening this wealth exodus problem or hitting growth elsewhere. Or 3, loosen the fiscal rules themselves.
But loosening the rules could spook the bond markets, right? Push up borrowing costs, mortgage rates.
Exactly. That's the risk.
So it really highlights a tough question. When finances are already tight, how costly are policies, even if popular with some, that end up driving away investment and shrinking the tax pot you desperately need?
It's a sharp lesson in unintended consequences, perhaps.
I think so. We've seen a clear chain. Specific tax policies, a very clear reaction in the prime London market, setting it apart from the domestic market, and now some serious complications for the national finances.
So we'll leave you with a final thought to consider. If these UK policies are, in effect, making London less attractive for mobile international wealth, Where's that capital going instead? Which other global cities, maybe Singapore, Dubai, Geneva, places like that, are potentially benefiting? And maybe more importantly, what are they doing differently to attract it?
Something to mull over. Definitely. Thanks for diving in with us today.